You find the perfect place. Your offer is accepted, and you're ready to close. But right at the finish line, snap, your financing breaks. In Florida, single-family home prices have climbed so high that standard entry-level buyers are increasingly priced out of traditional neighborhoods. To bypass this, buyers rely on two strategies: purchasing a condominium for a lower sticker price, or utilizing down payment assistance, or DPA. DPA is a broad category of state or local programs that provide grants or secondary loans to cover the upfront costs of a home purchase. This chart compares median single-family home prices next to condo prices. A 3 to 5% condo down payment requires a fraction of the cash. But even with DPA approval, lenders can deny the loan based on the specific building. Underwriters reject these loans because the building is classified as non-warrantable. A non-warrantable condo is a property that fails to meet the specific financial and legal safety standards required by major government-backed lenders like Fannie Mae. Navigating this market requires you to master two systems at once: the rules for state assistance and the classification of homeowners associations, or HOAs. An HOA is a private organization that manages a condominium building, collecting dues to maintain common areas and enforcing specific community rules. Securing the money is only half the battle. Finding an eligible property to accept that money is a separate conflict that can cost you your earnest money deposit if you get it wrong. Down payment assistance is a spectrum of repayment conditions that dictate how long you are legally required to keep and live in the property. This matrix shows the different tiers of assistance. On the left are grants. These provide $5,000 to $15,000 in free money, but they are hyper-local, and their funding often runs out by midsummer. In the middle are forgivable loans, such as Florida Assist. These are 0% interest second mortgages that burn off at a rate of 20% per year over a 5-year period. If you sell or refinance before that 5-year window closes, the forgiveness stops. You are required to repay the remaining balance in full at the closing table. On the right are deferred payment mortgages, like the Hometown Heroes program. These offer up to $35,000 for essential workers, but the loan is never forgiven. It stays on the property until the day you sell or refinance. Statewide programs are widely accepted by lenders, whereas local programs like the Miami-Dade surtax offer larger payouts but impose much stricter geographic and income limits. Regardless of the program, you generally need a minimum credit score of 640 and must fall under your county's specific household income caps. The larger the assistance payout you accept, the more you restrict your future ability to move or sell the home without a financial penalty. To use this assistance, you must secure a standard conventional or Federal Housing Administration (FHA) loan. The FHA is a government agency that insures mortgages to make them safer for lenders to issue to first-time buyers. These loan types strictly require a warrantable condo. This scorecard lists the 3 primary metrics for a warrantable building. More than 50% of the units must be owner-occupied, less than 15% of owners can be behind on their HOA dues, and the association must dedicate at least 10% of its budget to reserves.
Buildings that fail these metrics are non-warrantable. These are typically properties with high investor ratios, short-term rental operations, or active structural litigation. Lenders reject these buildings because a homeowners association with poor finances or high investor concentration represents a systemic default risk to the bank. If you choose one of these buildings, your only option is a non-QM loan. Non-QM stands for non-qualified mortgage, which is a type of loan that uses alternative criteria to verify a borrower's ability to repay when they don't fit standard federal rules. Resorting to a non-QM loan is expensive. It requires a 20% down payment and higher interest rates, and it automatically disqualifies you from using all state assistance programs. You can utilize state assistance, or you can buy a non-warrantable condo, but you cannot combine the two into a single transaction.
There is one narrow pathway to bypass a building's unapproved status, known as spot approval. This flowchart shows how spot approval works. It allows an underwriter to grant a one-time exception for a single unit within a building that otherwise lacks agency approval. Even for a spot approval, the building must meet strict prerequisites. It must have at least 5 units, be fully constructed, and have 0 pending structural litigation. Pursuing this is a financial risk. Property management companies often charge buyers hundreds of dollars up front just to provide the association documents the underwriter needs to review. Paying for these documents does not guarantee an approval. The underwriter can review the financials and still reject the unit for any reason. Spot approval is a volatile gamble. While it can save a doomed deal, it is too unpredictable to serve as a primary buying strategy.
To find the right property, you must map your capital and career profile against the available financing paths. This chart measures your upfront cash against the complexity of the condo's classification. An essential worker, like a teacher or a nurse, typically has steady income but little cash for a down payment. This buyer belongs in the bottom left quadrant. Their path pairs the Hometown Heroes program with an FHA loan, meaning they must strictly search for warrantable condos. Compare that to an urban professional who has moderate cash and wants to live in an investor-heavy downtown tower. This buyer lands in the top right quadrant. They should skip state assistance, bring 20% down, and use a non-QM mortgage. Firm, crossing these strategies leads to an automatic loan denial. You cannot apply a low down payment FHA loan to a non-warrantable building. Identifying your persona before you begin house hunting prevents you from wasting months on properties that your loan type cannot legally purchase. Timing is everything with state money. Funding pools usually refresh in January and July and are awarded on a first-come, first-served basis until the accounts are empty. Before you fall in love with a unit, ask your realtor for the building's owner-occupancy ratio. That one number tells you if standard financing is even possible. Always cross-reference your target address on the official FHA and USBA online eligibility maps before you spend any money on non-refundable application fees. Success in Florida's market depends on engineering a mathematically and legally compatible transaction before you ever sign a contract.